Let's bring in CNBC contributor Peter Boockvar into this conversation. He's the chief investment officer at Bleakley Advisory Group. He's at the Future Proof Conference in California. It looks like a beautiful day there, Peter. Good to see you. What do you think of this print? What do you think this means for the Fed's path?
I think the Fed's still going to do 75 next week. I mean, there's an interesting situation where the markets are really focused on the data that they see right now in terms of commodity prices. They see in some of the real-time rent figures that the rate of change is moderating. They're seeing used car prices slow down. But the BLS lags in how it captures that. So that's why we have sort of this two-lane highway with both sides going in opposite directions. And I think that's why we rallied 200 S&P points in the 4 days leading into today, because the markets are driving on one side, and the BLS hasn't yet captured that. Unfortunately, the Fed is also lagging in how they are reacting to things. They're driving also with the rearview mirror type mentality. But I think in overall where rates go from here, whether it's 3 3/4, 4, 4 1/4, I think after next week's rate hike, we're going to start playing a dangerous game with the state of the economy. The next rate hike is going to be only the second time in 40 years that the Fed funds rate is going to exceed the prior peak in a rate hiking cycle. So, again, we're getting into treacherous waters, I guess, with this aggressive Fed from here.
BK, I'm curious, based on what Peter said, if BK, you think that that's one of the reasons why the Fed should sort of wait. I mean, we don't know how this is going to impact the consumer. In terms of the wealth effect and the amount of wealth destroyed from the consumer perspective, it's not just the stock market, it's their home price as well. Their wages don't go as far because of inflation, and we don't know how this is all going to pan out when it comes to the jobs market yet.
Right. I think that's the big concern. And I think that's what the stock market's starting to price in. They're starting to say, we have had, as Peter mentioned, this incredible amount of tightening, not only just in rates, but the stock market, as you mentioned, housing going down, and housing's just starting to crack. We're just barely seeing the cracks in housing. So as that starts to come down, people are going to feel like they have less money than they did before. And then we don't know what that's going to do to the economy. So that's why I think, and I'm more on the side of Peter here saying, listen, after this 75, this 75 might even be a mistake. We know there's a lag. So, and we know that there's sticky inflation. So leave it here. Let's see what happens and be ready to start cutting rates if the economy really comes down. But first, the stock market has to decide that margins are going to come in and that earnings are going to be a lot lower than what people are forecasting right now.
And we started to see a glimpse of that in terms of third quarter earnings forecasts being trimmed by analysts, Tim, at this point. But I'm wondering what you think in terms of, where we should be, because this is a group, and I'm just speaking broadly here, on this panel today, who's always thought that the Fed should have gone sooner, should have gone harder. And now we're at this point where it sounds like a lot of you are a little bit worried about the impact because we haven't seen it all filter through yet.
Look, that's fair. And we've talked Fed credibility, lack thereof, over the last couple of years and maybe even for the last 5 to 8 to 10 years. But if you think about it, this is a Federal Reserve that could not raise interest rates 25 basis points in 2018 and actually turned the market into a convulsion. And ultimately, they had to step back in and begin this easing process. And I think what we're talking about here is a Fed that's done something unprecedented. Remember, this is a Fed that also, after that July meeting, where they pretty much indicated we just don't know what the impact of our rate hikes will be. That led to a lot of this Fed pivot dynamic that I think markets have started to price in. So absolutely fair. I mean, we went from a place where we could not raise rates even in good times, let alone difficult times, let alone a global energy geopolitical crisis and a labor market that was nowhere near as strong back 3 or 4 years ago. I go back to say I think the labor markets are the biggest problem for the Fed because, again, socially, it's a very big deal. It's very important for our country that the living minimum wage has changed in the last couple of years. That pressure is only going higher. Unionization pressure is only going higher. And again, you have a housing market that I think still looks bubblicious. But should they pause? Maybe. Like, I don't think 25 bips on the margin, whether it's 50, 75 or 100 next week, is going to change the trajectory of an economy that still has not digested this. But the most important thing you just said is third quarter earnings, I don't think, have digested this, and they are the ultimate lagging indicator.
Yeah, we're only just seeing them come in right now. So, Peter, how do you start thinking about equity valuations with this backdrop?
Well, let's take the PE side. We've obviously re-rated. That's typically the first phase of a bear market is you take off the froth and trading at about 17 times earnings. Now that earnings, are we going to realize that earnings? And I think Tim brought up a good point about corporate profit margins and its high sensitivity to labor costs. I mean, over the last 50 years, you can draw a pretty tight relationship with labor costs and the direction of profit margins. And with, at least on the services side, labor costs being almost 70% of one's expense side. So if labor costs remain sticky, if they continue to rise, at the same time the revenue side starts to slow in the face of this slowing economy, you're going to have further cuts in earnings estimates. At the same time, I don't think the PE multiple has bottomed out. I don't think this market just ends with the multiple at 17 times. Now, where it bottoms out, I don't know, but I have to believe it's going to be 15 or lower, which is more of a longer-term average past just the last 20 years.
Yeah, I mean, it's amazing that we're still stuck at 17, basically, because the E has come in a little bit. Julie, how do you think about where we are in the markets and how much needs to come in? I love it when people say this stock is down 80% from its highs, or this index is off 40% from its highs, because maybe it should never have been at that level. And so it's almost sort of a, I don't know, it's a ruse to think about it that way.
That's exactly right. Like, it's a correction. That's literally, it's in the name. It's a correction. It wasn't priced correctly in the first place. And I think if you look at valuations writ large for most of the economy, but tech in particular, they've got to points that just made absolutely no sense. And they were driven off of, narrative rather than true fundamentals. But if you're looking at the broader economy and valuations right now, I think they continue to look pretty expensive. And I don't think we've nearly begun to do the re-rating and the revaluations of earnings estimates. They've come down a little, but they haven't really come down that much. And it's not just wages, right? The supply chain makes everything more expensive, and then you get FX. And FX has a meaningful impact, not just in terms of, constant currency checking, but it makes our products more expensive abroad. So it has an actual real-world impact, and I think that's not at all been factored into estimates, not nearly enough anyway.
Yeah, just quickly, Karen, we just scrolled through the losses in big cap technology. So Apple, Microsoft down about 5%, Meta down more than 9% in one session. How do you start thinking about, especially the names that you own?
Right, like Google down a lot.
In integers, exactly.
Yes. Well, I love to say I like to start buying when things drop in integers, which they're doing. Although if you're a $100+ stock, it's not the same. One integer isn't as good as a $50 stock in an integer. But so I'm not quite ready. That's where the VIX is kind of a trigger for me. When you get selling in integers and the VIX in the 30s, then as painful and as scary as it seems, then I want to buy.
So too early right now.
Yes.
Too early. BK, you're nodding. Tim, you're nodding. Can we get a full box here? Oh, Peter, too. Let's put us all up here. Who thinks it's too early to start buying again in this market? Raise your hand, please. Too early? Raise your hand.
I think you could
be tomorrow, though. I mean, it could be tomorrow.
It could happen tomorrow. It could happen tomorrow. All right, Peter, we're going to let you go. Enjoy that day out there in California. Great to have you, Peter Boockvar, Bleakley Advisory Group. But if it came tomorrow, Tim, is there one name that you'd scoop up?
Well, I was giving you my Royals wave because it's not as simple as saying, is it too early to buy? I think there are companies like Google, less so Meta, but like Apple, like Amazon, that I think you can be building a position here. You absolutely should be building a position, and I think at some point we're going to see that these companies are going to be able to hold these levels. But I don't think it is tomorrow. I guess, to me, it's a case where we really have to digest the earnings quality that's coming up in the third quarter. And I'll continue to say what we've said many times. I haven't heard a demand warning out of any companies. Julie pointed out the issues with the dollar. I've heard dollar issues. I haven't heard about the rest of that.
This doesn't feel like an environment in which enterprise, BK, will keep up spending the same amounts of spending percentage-wise, whatever it is, as years past.
Right, and look at what the chip stocks did today. They got decimated. NVIDIA, you name it, they got decimated. So I think that's what's next. And then not only that, we do have a tight labor market. We're going to have some layoffs here, which basically means you need less computers for your people, right? I mean, it's pretty simple. So I don't think we've seen any of those effects yet. that's just starting. I mean, we haven't seen any layoffs. The unemployment rate is basically unchanged. So we're just starting to see it. A couple of the banks announced it today, but they haven't quite done it yet. So you have a lot of factors here that it's just starting. That's why I was shaking my head and raising my hand. I don't even think, sure, in the short term, if you get a VIX at 30 and you get things just absolutely falling, that is a trading buy signal all day long. But I'm not sure that's the absolute bottom, because I think we've got a couple other shoes to drop first on the economy and on earnings.